Momentum Redux. Welcome to Securities 2026 Annual Outlook. For our highlights, we recap key events in 2025 followed by our outlook for 2026. Insights will be given on 2026 key index target before moving on to our sector strategies. Let's begin. Overseas, U.S. equities delivered a strong trend driven by robust gains in technology stocks. Major U.S. indices finished 2025 on the plus side, with Nasdaq advancing 18%, S&P 500 by 15%, and Dow Jones Basket 12% higher. Resilience was achieved despite macro and geopolitical headwinds. Across Asian and U.S. markets, global equities were mostly positive, led by South Korea, Hong Kong, and mainland China. The storybook rested on tech-based rally and optimism for AI-related counters. In contrast, Philippine equities lagged regional peers driven by domestic issues. On a closer look at home, the PSEI had a volatile 2025. Local equities weakened in April following President Trump's reciprocal tariff and recovered slightly in May. Sentiment in June turned cautious with results from the midterm local elections, and volatility started in July when the flood control corruption scandal was unearthed. The political probe became a heavyweight on confidence, pulling the PSEI to its 5-year low. Given President Marcos Jr.'s political shuffle and institution of the Independent Commission on Infrastructure (ICI), however, gauges have since gradually returned from lows. And on a sector perspective, the mining oil index ascent was pronounced, driven by strong rallies at the metals market. Services came in at a distant second, aided by strong performance from cargo throughput operator ICTSI. The other counters lagged, led by holdings, industrials, and banks, which were affected by fund rotation. 2025's overall volatility prompted investors towards defensive and dividend plays. Among index basket, ICT logged 47% gain on optimism over global trade, followed by LTG and Pure Gold. Meanwhile, 24 out of 30 issues weakened, led by Plus, Jollibee, Monde, ASEN, and Globe. Plus took a hit when government broadened its crackdown on Philippine offshore gaming operators or POGOs, as well as e-wallet delinking that led to lower online gross gaming revenues. Monde took a drag on higher edible oil costs that compressed margins and declining meat alternative sales. Non-index stocks exhibited divergence in results, with gains largely concentrated on mining names Apex, Philex, Lepanto, Manila Mining, and Dizon Copper. Meanwhile, Villar-related shares such as All Day, Home, Haven, and P-REIT weakened on heightened Senate scrutiny on valuation for Villar City and possible links to flood control projects. On foreign investor participation, net foreign outflow widened by 156% to 52 billion in 2025. Net foreign outflow was visible in Ayala Land, SM, Banco de Oro, SM Prime, and Jollibee last year. Meanwhile, those that merited foreign buying interest were ICT, China Bank, and AREIT. China Bank, AREIT, Plus, and RCR benefited from index inclusion and rebalancing. Moving to economic outlook. Having regressed to 4% GDP growth in third quarter, our estimates have been tempered to 4.5% to 4.7% for fourth quarter. That would bring full year 2025 GDP average to 4.8%. This is slower compared to 2024's 5.7% economic growth, driven largely by the pause in infra spending. With key reform commitments from PBBM's administration, recovery is seen in 2026 at 5.1% to 5.5%. Key pluses on consumption include managed inflation plus annual increases in wage rate, seen at 5 to 6%. We see gradual pickup in fiscal spending, especially with the approved national budget increase of 7% to 6.8 trillion. On the investment side, the spillover of create more incentives, specifically in lowering corporate income taxes, would help attract foreign direct investment inflows. Meanwhile, key challenges cover effectivity of higher utility rates, especially with the latest approved tariffs on electricity and water. We expect implementation to be managed overall through dialogue between private concessionaires and regulatory authorities. Also, U.S. fluid tariff policies remain that could weigh on investments, while higher net trade deficit is hinged on possible extension of current tariff on rice imports. For 2027, GDP outlook is seen to improve to 5.2% to 6%. On consumer prices, full-year average inflation has been on a downtrend from 6% in 2023, 3.2% in 2024, and 1.6% in 2025. For 2026, we estimate inflation to average 2.4 to 3%, depending on rice price movement as well as adjustments in water and electricity rates that include Meralco's fifth regulatory rate rebasing and recovery of prior year's losses from SMC and ASEM. For index outlook, 2025's negative headlines appear to have been factored in and rebuilding is in place. The PSEI is moving within 6,000 to 6,500, implying forward PE multiple of about 10 times. Advances towards 7,000 will take its support from cheap valuations, vigilant implementation of infra project monitoring through Cadena Act, or the Citizen Access and Disclosure of Expenditures for National Accountability Act, and expected tourism recovery with the Philippines hosting of ASEAN 2026. Adding support to regaining the investment community's trust and confidence, President Marcos Jr. appointed 3 economic triumvirate in his team. Recto as Executive Secretary, Go under the Finance Bureau, and Mendoza for BIR. These 3 are anticipated to keep track of progress, especially in fields that create the most multiplier for the economy in terms of strategic decisions. Complementing the investing terrain, 2026 marks the year of the fire horse in the Chinese lunar calendar, with equine traits of strength, power, speed, and dynamism. Fire energy represents illumination or visibility, vitality, and expansive traits. On the field of global investing, forecasters see fund managers making bold moves, bigger risks with decisive action. And industries seen to thrive are those associated to light and power, jewelry or extraction, cutting-edge technology, digital devices, and cooking or restaurants.
Guided by sound principles, we have outlined portfolio selection in 3 sectors: defensives, real assets, and dark horses. By defensives, these cover stocks with core business models that can withstand economic pressure. Real assets are those with assets that appreciate over time, while dark horses are those we think could outperform with their vision. Banks as well as consumer retail are part of defensive basket. These have good upside potentials and solid underlying stories. Relative to their historical price pattern, the highest ranked upside potentials are Metrobank, BDO, BPI, and East West. For consumer retail, Jollibee, and Pure Gold. JFC's spin-off of international assets is long-term accretive. Overseas operations account for about 41% to Jollibee's top line. While the timeline is slated late 2027, the move is seen to unlock values for overseas demand and allow autonomy versus the local business. Using available data, the price-to-book value of international assets is around 49 pesos a share, and the average price-to-book value of select peers of fast food stocks listed in the US is 7.4 times, implying good upside. Aside from the dividend play aspect, margin compression for banks might benefit in the second half once the monetary easing stabilizes. From 2022 to 2025, the central bank has raised interest rates by a total of 450 basis points and lowered by 175 basis points, leaving a variance of 275 basis points. For the same period, the US Fed made a total of 375 basis points increasing and lowering of 175 basis points, leading to a variance of 200 basis points. Two rate cuts of 25 basis points each might still be underway on domestic interest rates, narrowing the gap with the US Fed rate.
Still under defensives, resilience is underscored for container throughput operator ICT. Upsides are in store with full-year contributions from Terminal of Batam in Indonesia and Durban 2 in South Africa. Higher cargo handling rates are also in store at Manila Terminal or MICT. Also, renewable energy prospects remain brisk. Upside are in place for long-term gestation projects from ASEAN, AP, and Meralco. The Philippine Ports Authority, as mentioned, approved 20% tariff increase for both cargo and passenger tariffs. Additionally, PPA sees 4% growth in throughput volume at 321 million metric tons and 6% for passenger traffic to 87 million. This will support ICT premium given the firm's EBITDA growth. On renewable energy, the Philippine hosting of ASEAN Summit in first quarter this year will highlight RE in its agenda, with strong interest anticipated from the international community. Two highly anticipated big-ticket items are going live this year and in 2027. M-Green's M-Terra Solar Stage 1 is seen to go live in first quarter of 2026, targeted to deliver 364 MW. Meanwhile, ASEAN's Giga Ace 8 is building its 26 billion pesos solar farm with 420 MW peak capacity plus 1,300 MWh battery energy storage system or BESS, slated for commercialization by 2027. And finally, REITs and water utilities are covered under defensive bets. Both REITs and water utilities define the quintessential definition of defensives: stable, recurring cash flow with the added benefit of competitive dividend yields, especially attractive during the low interest rate environment.
Under real assets category, or those with assets that are seen to appreciate over time, we have property and mining. While the property sector suffered from the oversupply caused by POGO exits, the market rewarded those that embarked on horizontal projects and NCR. Also, land banking initiatives, either on the parent level or through joint ventures, will help secure price appreciation potentials. Mining firms, meanwhile, cannot be ignored. Coupled with the signing of the Mining Act, the banner is on the Philippines' vast mining reserves that could unlock economic potentials. Property sectors, given the lengthier duration of their business cycles, enters 2026 with the same story as of end 2025. Condo oversupply being offset by RFO sales, but with the added variable of infra scandal slowing down the premium market. For the office segment, Colliers are seeing vacancy rates stabilizing as the lagging effect of deliberately controlled launch of new supply is starting to take effect. Gold's momentum remains intact heading into 2026, even with equities remain strong. Major financial institutions including JP Morgan, Morgan Stanley, RBC Capital Markets, and Deutsche Bank forecast higher gold prices through 2026, with price targets often exceeding $4,500 per ounce, and in some cases topping $5,000, driven by ongoing central bank buying and strong investment demand. According to the World Gold Council, central banks are expected to remain a key support in 2026, with first quarter acquisitions alone projected at around 585 tons following scheduled forward deliveries. IMF data shows global central bank gold holdings reached roughly 36,200 tons by end 2024, now accounting for nearly 20% of total official reserves, up sharply from 15% a year earlier. Institutional organization estimates suggest that every additional tons of central bank demand could lift gold prices by about 2%, highlighting how sensitive prices remain to incremental buying. Even with purchases moderating to an estimated 755 tons in 2026, central bank demand remains historically elevated, reinforcing gold's structural support and keeping upside risk firm in place. Despite the US dollar remaining structurally resilient over the past 5 years, as reflected by the decline in the SDR versus USD, the proliferation of financial sanctions has prompted several countries to increase gold holdings in their reserve portfolios. This has reduced reliance on the US dollar as the sole reserve anchor. Consequently, Gold prices have rallied as both investors and central banks increasingly view it as an investment refuge and a geopolitical buffer, evidenced by gold's rising share of total international reserves. And finally, as the old adage goes, dark horses run their own race. These shares are seen to unfold their respective stories that may be a game changer in the process. MWide had recently struck a partnership with Pag-ibig for a 10 billion deal for the firm to turn over 7,000 homes in support of PBBM's 4PH program. SEB is poised for a bullish flight in 2026 with the addition of new versions aircraft and sustained travel demand. As seen in the markets in Seoul and Taipei, tech rally had sustained its strong momentum over continued heavy investments towards AI and its infrastructure. The rally of AI-related sectors is caused by their increasing prevalence in our daily lives. AI developments are being applied in healthcare, digital companion, and robotics. It is now assisting research for cancer research, neural implants, digital companionship, and generative AI, and robotics that automates repetitive tasks. We see IMI as a possible beneficiary given the increased demand for potential components to feed the hyperscale AI capex investments. Converge has an asset monetization potential.
To summarize, these are our top picks for 2026, which we believe are well positioned to outperform. Metrobank, Maynilad, Jollibee, and CPG provide exposure to defensive and income-generating stocks while offering compelling dividend yields. Our 2026 dividend yield forecasts are 7.1% for Metrobank, 6.5% for Maynilad, and 6.6% for CPG, making this group particularly appealing for income-focused investors. Maynilad are expected to be included in the PSE index in 2026, potentially driving passive funds inflows. For Jollibee, while details on its US spin-off remain speculative, we believe that it will be a long-term accretive given that it will provide enhanced operational flexibility.
CPG and Converge also offer upside potential. CPG is strategically exposed to affordable and horizontal housing, a segment benefiting from strong government incentives, subsidized financing, and resilient end-user demand. Converge is well positioned to benefit from the spillover effects of the AI investment cycle, offering exposure to secular growth themes and increasingly stretched valuations in global AI names. As of present, they already offer AI solutions to enterprise customers. And lastly, for SMPH, the ongoing tourism rebound and strengthening household consumptions are boosting mall traffic. Although residential revenue softened in 3Q25 due to cyclical pressures, healthy reservation trends point to a recovery in demand.
To recap, the capital market is just coming from a deeply troubled year in 2025, resulting in a vast swath of cheaply valued stocks represented in the PE of 9.7 times. As it stands, US markets continue to trade at clear premium PE multiples of 25 to 36 times, while the highest in Asia was 24 times. The PSEI, however, stands out at just under 10 times earnings, making it the cheapest among regional peers. By 2026, we expect to see a positive transition, a rebound on the economy, as well as sentiment. The renewed optimism shall cascade towards better equities performance, unlocking corporates' upside potential. To optimally time the transition, our 2026 strategy is defensives, real assets, dark horses strategy, as it provides ample cover to capitalize on the trends for the year. Thank you, and see you on our next sequel update.